You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for the option block, everyone's favorite. I know it's my favorite. Hopefully it's your favorite bi-weekly source for all things options related. Coming to you live every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern, via Mixlr, Mixlr. You guys can get the links wherever you find our favorite content, social media on the website, etc. Or, of course, if you're on demand after the fact, iTunes, TuneIn, all those fun places. We love you guys as well, but we'd love to see you guys live. If you can make it every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. 15 programs for you guys to download and consume and stream at your leisure. The easiest place to find that when we're not streaming live over there on Mixlr is, of course, the mothership, the flagship, theoptionsinsider.com. It's all there, as well as a lot of great written content from the world of options, breaking news, analysis, unusual activity, education, all that fun stuff right there at your convenience. And when you're ready to begin your audio adventure, click on that Insider Radio Network tab, and your audio journey has begun. Of course, you can always find us iTunes, TuneIn, all those fun places, as well as via all those app stores. So the iOS App Store, the Google Play App Store, as well as the Fire App Store. Just check out and search for the Options Insider Radio Network app, and you'll find all of our fun stuff. And, of course, all the great ways you guys can reach out to us are also baked into the mobile app. So if you're listening and streaming via the app and you say, hey, I have a question for those guys or a comment, hit us up. We love to hear from you guys. And joining me on the old program today, let's start off. We won't go in order of proximity. We'll go in order of how they show up on my screen. So starting off in the land, the paradise on earth known as St. Charles, Illinois, we are joined by Uncle Mike Tussaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program, sir. Good to have you back from your special assignment.
Oh, always happy to be back from those type of special assignments. Great to be here on Thursday.
All right, we will be joined forthwith by the Greasy Meatball himself, making his way through the rain-slogged, sweet streets, I should say, of Chicago over here to the Options Insider Studios. But never fear, listeners, we have an able stand-in in the form of today's special guest co-host. He is Ben Londergan, the Executive Managing Director and Head of Options Trading and Technology over there at Convergex. That's quite a business card, Ben. Welcome to the program.
Thank you. I'm very happy to be here, Mark.
You must have to unfold the card when you take it out of your wallet and just unfold it a little bit. So here you go. That's how you fit everything onto one business card.
It's a trifold. You got it.
Well, Ben, you've been on the network before, so we don't need to go deep into it. But, of course, this is your first time on the Option Block program. So maybe really quickly for those of our listeners who aren't familiar with your background in the space, as well as what it is you guys do over there at Convergex, why don't you enlighten our Option Block listeners?
Sure. Thank you very much. I started in the business at working in Group 1. I worked there for about 16 years, the last 10 of which I was the CEO. I was also on the board of directors of CBOE for some time, and now I work at Convergex. Convergex is basically an agency broker-dealer. The area I specialize in basically specializes in options trading. We provide technology and options routing to give access to the options marketplace.
There you go. And with the gang mostly assembled, we're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. Like the man said, this is the portion of the show where we break down what was moving, what was shaking in today's market activity. It was an interesting one, a little bit of red on the old screen today. Most of the indices finishing off sharply lower. Like I said at the top of the show, we are recording this and streaming it live on Thursday, September 29th, for all of you playing along at home after the fact. And like I said, a lot of red on the screen. Most of the major indices off nearly a full percentage point. The S&P closing off about 0.8 of a percentage point. The Dow off a little bit more. The Q's off a little bit less. So the S&P kind of the Goldilocks sweet spot for today. And of course, all of this red on the screen means a little bit of green on the old VIX cash, finishing up nearly two handles, right around 14 and a quarter or so here on the end of the day. So a lot of interesting stuff to parse. But since maybe we'll start with you, Ben, because you're our guest today, so we'll give you pride of place, perhaps a dubious honor, but an honor nonetheless. So I know you guys are busy over there executing a lot of different stuff. You guys execute out there in the VIX, obviously, as well as SPX and a lot of other products over there at the CBOE. So maybe we'll start there. What, if anything, caught your eye in today's market activity, or maybe some of the paper you guys were filling over there at Convergex?
I think the biggest story for today was really Deutsche Bank. You saw a pretty strong move down in the stock and some decent trading activity in the options around that. The story there is kind of a familiar one with bank struggling with potential regulatory issues and fines, and it seems like there are some investors / people who had assets domiciled there who have gotten at least allegedly or are alleged to have gotten somewhat spooked a little bit. So it'll be very interesting to see what happens with that stock and whether or not they can stabilize themselves from a kind of a messaging perspective with respect to what's going on, around the potential fines, et cetera.
Were you guys doing a lot of paper in DB today?
We were doing a decent amount. The other thing, as you mentioned earlier, is you saw VIX popping, and again, we've seen a lot of trading around the VIX pops. Unfortunately, they seem to be shorter and shorter lived. That the Brexit seemed like it was going to have a prolonged spike in volatility, which didn't end up materializing, and the sell-off we had a week and a half or 2 weeks ago seemed like it might be the start of some pretty interesting trading environment, and it really hasn't played out that way. We've seen, unfortunately, overall OCC volumes trending back downwards fairly quickly after the spike we saw, kind of towards the beginning of the month.
And Uncle Mike, I know you are deeply attached to the screens out there in Old St. Charles, watching your usual stalwarts, your SPY, your Apples, your GLDs, as well as a few others. So what in today's sea of red, for the most part, unless you're talking a Vol or perhaps a handful of others like Chipotle, what caught your eye in today's activity, sir?
Well, I think just to add to what our previous guest had just said, good to have you, by the way. I think that what the big story was today was definitely Deutsche. I think there's a lot of unknowns. I think that this is one where the media was actually said the word derivative, and I think that kind of spooked the market a little bit. I believe they have they have trillions of dollars in notional value with their derivatives there, but you have to kind of get some perspective. What actually is there? If it's something that is the equivalent of something super out of the money and it's a short option, then it's really nothing to be fearful of yet, but it's something with which to be concerned, and how well they're managing that remains to be seen at this point. So I think a lot of that was just the fear with what had happened, what could potentially happen. And I'm thinking it's a little bit of an overreaction from the marketplace, but you never know. Who knows? So that was obviously the big story of the day. Gold, silver, relatively flat on the day. And the other thing that I noticed was that yesterday we had a 5% increase, I believe it was, in crude oil. Today, crude's up again, a little over about 1.5%. And so it appeared that yesterday everyone was bullish due to the meeting that comes out because all the countries are going to come together in the Middle East and whatever. But today it's a little bit more flat. But considering the fact that XLE is down 12 cents on a market where the S&P is down about just under 1%, I think that could still be a sign of strength in the energy sector. So that is what is on my radar, or it's lighting up my tape as of today.
All right, we are also joined, better late than never, by the greasiest of meatballs, Mr. Mark Sebastian, straight from the Carmen Line HQ. Mark, glad you could survive the rain-swept streets here of Chicago on the perilous journey all the way to the Options Insider Studios.
Yeah, quite the day today, huh? It's looked like it was going to get really ugly, and then just ended up ugly. But we shall see. I think there's real potential for this to turn into a problem, not because it isn't stupid. I mean, let's face it, this Deutsche Bank thing, it's really a stupid story. I feel like I'm wasting my time. But if you think about a hedge fund manager or a trader that has money clearing Deutsche Bank, if you were a hedge fund manager or a trader clearing Deutsche Bank, and you saw what happened today, would you be willing to leave your money with Deutsche Bank over the weekend?
Yeah, when it doesn't exactly inspire enthusiasm. You have kind of memories of the old days, the bad old days of the old days of rolling your wheelbarrows full of Deutschmarks up to the bank back in the early days of the old Weimar Republic. Germany known for their runs on banks back in the past.
Well, you know what's interesting is I was thinking about this. In 2008 I was on the floor, and I was trading Fairfax Financial Holding. Got my butt handed to me on this trade. And you would think that the other side would have done great, except they got their butt handed to them too, because I lost on being short. He lost on I lost on my hedge. He lost on his actual trade, and so I was short vol, short stock, and that was a mess. And short put, and so what happened was the stock the FFH gapped up, and I had all this stock to cover, right? Well, you think, he probably did well, but we were actually trying to get him to close the trade beforehand, but he was clearing Lehman Brothers and could not get to his account to close the trade. And so
what could possibly have happened to Lehman Brothers in 2008?
Yeah, so he bought these puts from us for $45, up to $50. They were worth $90 when we started telling him, hey, you've done really well on these. You should unwind these. And then he didn't. I covered as much as I could. It turned into a mess for me. But then he unwound them at $15. So he got absolutely blown apart too. It was and that is the danger you run into when you are clearing a bank that is falling apart. So should Deutsche Bank have a run on itself? Probably not. The story is stupid. Could it happen? I'm 50-50.
Yeah, given today's activity doesn't exactly
it doesn't inspire
bolster confidence.
No,
but you're right. What you pointed out there is kind of interesting. Aside from the banks for a second, it kind of just points out the magical nature of options. Everyone could be a loser, not just. Everyone always talks about options being the zero-sum game, and I always laugh at that. You could all be winners. You could all be losers. It's all how you hedge. And so the moral of that story: we could all be losers.
Yeah, no, it was that was a mess.
Everybody loses.
Yeah, the only winner in 2008 were regulators.
Well, speaking of potential winners and potential regulation involved as well, Ben, I know there's a big issue that's been taking up a lot of the headlines here in the oxygen in the options world this week that I know is near and dear to your heart. That is indeed the whole CBOE BATS deal. We touched on this on Monday, but it seems like more is evolving over time. Of course, CBOE acquiring BATS for $3.2 billion. Yes, that's billion with a B, listeners. And acquiring them looks like primarily for their ETF and their technology, ETF business and their technology. A lot of people are out there bandying about that they have some sort of goal of trying to regain their market share leader in options. I kind of dismissed that notion, but Ben, You guys deal a lot with CBOE, obviously, over there. I'm curious, what are your thoughts on this whole deal? Did it surprise you as much as it surprised a lot of other people in the business? And what do you think the impact is going to be going forward from this deal?
It was definitely a very interesting deal. I mean, if you look at, particularly from someone who's deeply involved in the options market perspective, it wasn't a natural no-brainer deal, right? So you have seen some consolidation in the space, but it wasn't something you would have thought of, I think, necessarily offhand. That being said, kind of stepping back and looking at the the synergies of the combination as a whole, I think it makes a whole lot of sense. You mentioned a few of them. In addition, CBOE is going to get access to the equity marketplace. It's going to get access to European equities. It's going to get access to an FX platform. So there are some really interesting things, I think, that CBOE now is going to have access to that they wouldn't have had access to previously. And again, I think if you look at kind of the CBOE proprietary products as being a kind of a base key source of revenue and profitability for them, it's a good way for them to really expand their brand. And again, the added benefit of being able to have brand new technology, I think, is it's going to be a real win for them.
One thing I think about is that CBOE was about the only player that did not have a successful make-take exchange, and BATS is that. So, do you foresee BATS? And obviously, this is just your thinking. Do you think BATS replaces the CBOE hybrid system and the hybrid 2.0 systems, or does BATS kind of take the place of what C2 was meant to do from a U.S. equity option space? How do you think this affects the CBOE platform? And then, obviously, the big question a lot of people are asking in my neck of the woods are what effect does this have on the floor trading operation? Because up until this deal was announced, there was a push toward the floor, not away from the floor, out of CBOE. So, what are your thoughts on that?
I'll start first with the floor. I do not think that the floor will be impacted by this move. I think CBOE recognizes the positive impact the floor has on the trading community, specifically SPX and VIX. Those are both still very institutional products, and I think the way trading works in there has worked well for CBOE, and I believe they recognize that. So I don't foresee a change there. With respect to the options exchanges, first of all, I would say I do believe that CBOE is going to move fully onto BATS technology. I'm not sure, Mark, if exactly that was your question.
What happens to the non-floor traded stuff?
Yeah, I think that will trade on. And again, you're talking about a complicated system that CBOE's built. But yes, I believe they'll move it onto BATS's platform. And I do think the goal would be to keep all four exchanges open. Again, who knows what's going to happen moving forward with that structure. Clearly, NASDAQ has 6 now. So again, unclear whether or not 4 is quote unquote too many. Certainly, the play seems to be the more medallions you have, the more flexibility you have around trying new things and being innovative. And certainly, I think that the exchanges tend to see that as something that's helpful for them at what tends to not be that much of an incremental cost increase.
All right. So as like the market structure expert, here was kind of my hope when I heard about now that, I felt like the industry needed consolidation for a while in order to get liquidity back. Not in the auction setting. I think auctions work okay, but in terms of I need to lift an offer right now, that liquidity has dissipated outside of the front weekly option and the standard front contract. So on the one hand, you have the benefit of 4 exchanges and 6 exchanges, but you have to wonder, do you think that there becomes a point where they look and say, why do we need all of these different technology platforms? And we go back to a system where there's actually, we contract I mean, what is it going to take to make that happen? And I understand that was a long question.
No, it's a great question, Mark. It's a tricky one. Unfortunately, I think the exchanges are in a bit of a prisoner's dilemma there. So kind of a classic game theory problem where if you're the first mover to close an exchange and you do so theoretically for the good of the industry to try to generate more top of quote traffic, on the NBBO, I think you end up being a loser there. I think what you would probably need to see happen is something happen from a statutory or regulatory perspective, whereby you would see, multiple exchanges closing kind of quote unquote simultaneously. Again, there are other things that could happen that would trigger the need for exchanges to reevaluate their cost structures. That being said, until that happens, it's hard to say. It's hard to believe, I think, that they'll voluntarily start closing. It's possible, but I haven't heard that's in the plans.
You would need all-out rebellion from one of the market participants, I think, to make that happen at this point, right?
Yeah, and listen, I mean, I think there are other ways. There are other more creative ways to generate top of quote, traffic. I think everybody recognizes or would admit that, that's our best advertising we can do to entice clients to feel comfortable trading the product is really having a stable marketplace and having a thriving bid ask and having enough liquidity to fill, to satisfy the demand for the electronic users. Those things would all be great. Again, I think there's some better things you could do or more creative things you could do other than quote unquote closing an exchange to help incentivize people to quote more aggressively. So there's a kind of a whole host of things you could potentially do there.
Yeah, I've always kind of commented that the auctioning technology and all of that, that's the intelligence. The top of quote is how good looking you are. So think of top of quote as being a really good looking guy or girl, and all the other bells and whistles as being their book knowledge and how good of a person they are.
Personality last.
It's the person. So auctions and quote books and spread books. That's your personality. Your top of quote.
That's the sex appeal, right?
Yeah,
there.
that's the top of quote. The top of quote is the Victoria's Secret model or the men's fitness, the men's health model.
Speaking of sexy, C2, we hardly knew you. C2 came around, we had SPXPM and a few other things out there. And then they kind of let it sit there. They seemed like they had it in their back pocket for a rainy day. Ben, you sound like you don't think they're going to be shutting anything down anytime soon. Although on the flip side, I can't really see them, maybe accreting a lot of business to C2 as a result of this deal. I suppose we'll have to wait and see. But that would be an interesting side product of this deal if C2 suddenly became a raging monolith in the options space.
I just assumed that they were going to roll BATS into the C2, the BATS platform into C2.
That would seem to make sense.
C2 doesn't do anything.
But then things that make sense in the option space don't always unfold. NASDAQ's still running, 6 exchanges, I believe, right now.
Why?
6 medallions. Those medallions are hard to come by. Once you get them,
they're like, well, here, ask what happened to the value of a taxi medallion.
Yes, it's a similar analogy. Where's the Uber of the option space?
We need the Uber of options.
But speaking of exchanges and kind of market share, Ben, I'm kind of curious because, like I said, when this deal first was announced, the news first broke, I saw a lot of people out there in the media kind of speculating that the key driver for this was CBOE somehow trying to acquire the BATS market share, and a lot of people doing some funky math that CBOE share plus BATS share equals this larger share of the options pie. When I think as we all know on the show, one share of one pie is orders of magnitude more valuable than another share of another pie that is typically in, so shall we say, some of the lower margin business like the Apple retail flow and everything like that, where you have to effectively scrape and pay rebates to get a lot of that flow going your way. So I'm sure they're not going to throw that business away, but I never saw that as a huge driver of that. I'm curious your thoughts on that, on CBOE's desire to become the total number one options exchange being the key driver for this deal going forward.
I definitely don't. Look, I think that's certainly an important part for CBOE, and I don't think they would be dismissive of the value there, but I certainly don't view it as the key driver. I mean, I think there's a whole host of other things that CBOE sees that are more strategically interesting or valuable to them than just quote unquote increasing market share from an options perspective, right? I mean, to put a finer point on it, right? If you were CBOE and you just wanted to increase your market share, you could spend $2.7 billion on increasing incentives to send flow to CBOE to increase your market share, right? That doesn't strike me as really a viable headline strategy for them in terms of why they would have done it that way. But again, you can't take away from that as a very important piece of the puzzle for CBOE. I mean, I think CBOE's done a very intelligent strategic transaction, and certainly increasing market share and increasing market presence and options is a big important piece. I just don't think it's the headline for them.
Yeah, no, Ben, here's a question for you, and then we'll drop this BATS thing because people are gonna felt like they got hit over the head with a bat with this merger talk. When I look at this merger, I think two things. One, just from a CBOE perspective, obviously this merger makes them much more difficult to acquire from another exchange. So it's got a bit of a poison pill to it for the directors and the board members. I don't think that's their main driver. But two, they've got this amazing proprietary technology and proprietary products. Where could you see CBOE, who loves to license their VIX methodology and some of their other things, using the BATS platform to try and launch VIX-based products or VIX-based, of that ilk into places like Europe or Forex or things like that?
It's a good question. I see that my belief is that CBOE thinks that there's probably some upside to them with respect to BATS' position as a U.S. equity exchange, and certainly there's been a lot of talk and articles about ETFs, and I view CBOE really. I wouldn't say VIX certainly and SPX are incredibly important to CBOE. CBOE also, I think, has done a decent to very good job in terms of being a leader in the kind of index space. And again, I think index ETF creation is something that's potentially interesting, an interesting strategic play for them with BATS. Certainly, I think BATS' presence in Europe will be helpful for them. I don't know exactly what to expect when it comes to listing of products over there. CBOE's already listing overnights on SPX and VIX, so I don't know that I expect to see much there in terms of new product launches. That being said, certainly the presence and the sales presence in Europe should help CBOE's push to get more customers and clients actually trading the ETH sessions, et cetera, and vice versa. So I think those are some things strategically that I would expect to see.
We could keep talking BATS CBOE for quite a while, but we got to keep rolling on with the program. So without further ado, let's keep on rolling right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. That funky tune means it's time once again for the Odd Block, the portion of the show where Mark and I typically, or Andrew, typically don our fancy fedoras and our trench coats. But Uncle Mike and Ben, you guys are sure welcome to follow along as well here on the old program where we dive where the angels fear to tread in the old marketplace of options, of finding some interesting, some may say head-scratching, some may say downright dubious paper. We're going to kick things off. A name we haven't talked about in a little bit, but used to be a frequent offender here on the old program. This is Pfizer, ticker symbol PFE, closing today about $33.32, off about 2%, so outpacing the market a wee bit to the old downside today. This is the name that does about 34,000 contracts a day. So from an odd block perspective, Mark, this thing is just lighting it up. And today doing a lot more. Today doing about 103,000 contracts today, about nearly 2.5 to 1 calls over puts. That should give you some inkling, listeners, of where our attention was drawn. It was indeed on the call side. Looks like a bit of an interesting call spread out here. Not a vertical though, a time spread. In particular, it was the November expiring on the 4th versus the November expiring on the 18th. So traditional November, good old Nov as we would call it. 33 call spread going up, starting about 27,000, nearly 27,500 times. Looks like paper buying the longer term Novs and selling the nearer term. As the day went on, it's like a total of about nearly 31,000 on the near term, and about 31,000 as well on the longer term leg. The Nov 33 is going up in 3 blocks over there on the Philly. Interesting, too, a couple of reasons why this is interesting. A, the size. B, we don't see a lot of time spreads to this degree. Usually we see a lot of verticals and things up here. Not as much on the time spreads out here in the UA for odd block, which is interesting. And also, perhaps some of the interesting and perhaps stealthy reasoning behind this one, Mark. Of course, we do have earnings as well as perhaps a little bit of a bet on some divvies coming up here as well in good old Pfizer. I know you were paying attention to this one earlier today, Mr. Greasy Meatball. What are your thoughts here on a size time spread going up here in Pfizer?
Interesting play. They were clearly selling the front, buying the back, kind of near the money, but actually slightly in. Does appear like it might have been some sort of weird dividend capture if the stock rallies, and maybe an earnings thing, but it was opening on both ends. So absolutely an opening trade. So the guy's either set up a very weird way to be slightly bearish, or he's planning on nothing happening between now and an expiration, and getting this whole business off, and we'll see. I have no idea. Honestly, it was a confusing trade.
Yeah, it's a bit of a funky one. Not perhaps traditionally what you would see. This all went up on the Philly, Ben. So I'm guessing your guys weren't putting up the size blocks of it. But if you have any thoughts on it, feel free. Meanwhile, we're going to keep on rolling, of course, into our next name. This is indeed another name we haven't talked about in a little while here on the old show. This is Baker Hughes Incorporated, ticker symbol BHI, closing today about $50 and a quarter or so, up pretty much almost the exact opposite of the market, up about 0.8 of a percentage point or so, or about 40 or so cents. This is the name that does about 5,200 contracts a day, doing about 3x that today, about 15,000 and some change, about 17 to 1 calls over puts. So that should give you some inclination of what we saw out here today. And scrolling down a wee bit, what caught our attention in all that call frenzy, Mr. Greasy Meatball, was indeed Nov. Nov where the action is today.
Call sweepers.
Yeah. Nov is where all the action is today.
Yeah, they were
odd
buying
block.
calls. They wanted calls. They wanted them good and plenty. So there was a rumor going around that Anadarko might get bought out and the suitor was rumored to be ExxonMobil. And that's floating around out there. Baker Hughes was involved with this. Wasn't he involved with Halliburton? Whatever. That deal fell apart, though, right?
I do believe those names were linked at one time in the past.
But maybe this is now that oil is back in play, they can try and get the merger going. And all I know is that there were call buying on these no 52.5s, but really across multiple strikes, and it was a name where money was buying all day.
Yeah, no 52 halves. You said it right there. It was a no 52 halves, lighting it up when we first started profiling these. Paper buying nearly 4,000 for about $1.54. As the day went on, that of course that initial kind going up over there on the ISE in a big sweep as the day went on. About nearly 3x that, about 12,000 and some change total on this strike. The latter kind, obviously, for different prices. All on a whopping 52 contracts open interest here, Mr. Greasy Meatball. So an interesting play. If it is indeed a straight-up upside call play, as it appears to be, we didn't see any stock or anything else going up with this, and there is indeed no open interest, so it's no roll, no closing here. It is an interesting level. Baker Hughes, you said there is some takeover talk, so that could be interesting in and of itself. Of course, this name hasn't reached these lofty levels in quite some time, about a year ago when it was trading a little bit north of where it is now, right about 56 or so. And it'll clearly need a nice pop back into at least that range for these calls to start looking good. And before we wrap up here in the old odd block, we'll talk, actually, I think this is a bit of a newcomer. This is our resident pharma name for the day, Mr. Greasy Meatball. This is Vanda Pharma here, ticker symbol VNDA, closing today about $16.25, off about half a buck or nearly 2.6%. This is the name that does a whopping 500 contracts a day. That's more of what I expect from our odd block candidates. Today, doing well more than that, about 15,000 today. Fairly even paper, actually. Only about 1.6 to 1 calls over puts. So it wasn't like it was a breakout move to either direction in the options that caught our eye. More just a spike of an interesting. This is another. Gotten in the funky basket. This one certainly applies. First off, we saw about 3,120, to be precise, of the Nove 11 calls going up. Looks like paper sell-in for, if you know that pricing, can do your basic math, pretty close to parity on those calls. That's against about 3,200 contracts open interest. So it seems like our first leg here is a closing on some deep in the money calls here on Vanda. I'm guessing. Probably did all right on those. Just guessing, going off on a lim on that. But he wasn't done there, Mark. He wasn't saying, I'm out of Vanda, I'm done with my bullish nature. No, he decided to roll out to jam, but he's not gonna play the usual script to just buying some more calls, maybe the old up and out. No, he decides to leg into a bit of a funky, one of my old favorites, bullish risk reversal. Looks like the Jan 2017 15-18 bullish risk reversal, selling the put, buying the call, nice. And doing that also for some size to the tune of a little more this time. Again, an indication that perhaps he's sitting on some money. 6,000 on the 6,000 both legs, actually. So a total of 12,000 contracts. A total, again, on all this of about 15,000 and change. So a pretty sizable trade, making up pretty much the lion's share of that ADV today. Interesting one. Didn't see any stock going up with this. This is funky for a number of reasons: the multiple legs, the month selection, and the fact that it's not your standard. Oh, I'm going to close on the 11s and roll out to the 16s in Jan. Right. He's actually going a little bit more nuanced approach. So, what's your thoughts here?
Well, I actually am an expert on Vanda Pharma. They're engaged.
You use all their products?
Well, they actually are engaged in keeping Vanna White looking so
That's
youthful.
A full-time job, and obviously very lucrative as well.
Yes, they designed her dresses. They run her skincare. They actually are the people that figured out how to turn the letters where she could just press the button instead of having to turn the thing. So they've engaged a lot. No, it just looks like somebody that is had some deep in the money calls, unwound them, and then wanted a similar delta further back. Noticed the skew and used it to their advantage. So not a stupid trader is what I would say.
And Ben, I said I know you were pretty consumed with Deutsche Bank and all things trading.
Fortune.
Yeah, all things trading today, and a lot of this didn't go up on the CBOE. But of course, if you had any thoughts on any of this paper before we roll on into our next segment, now's the time, sir. Have at it. The floor is yours.
I'm good, thanks. I think Mark did a great job.
Wow.
Wow.
He's the one Mark fan.
Can you repeat that? Because I may never hear that again.
He's the one guy who downloads your stuff out there, Mark. Now I know. It's Ben. Now that's your one fan. I understand. All right. Yeah. Then with the odd block content, we shall keep on rolling. It's Thursday. It's time for Uncle Mike to dispense some options, wit, and or wisdom. It's time for the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, everybody, welcome back. It's Thursday. That means it's time for Uncle Mike to dispense some options, wit, and or wisdom. I haven't had a chance. I've been so busy in studio guests and everything else here, Uncle Mike. I haven't had a chance to check in with my minions, but I did give them a swift kick before the show started. They said something. They were tugging at their throats again, so either they were thirsty or something about collars, and then I thought I heard someone say something about puts. So have they earned their food and their jams and jellies yet again, sir?
They have, and if Sebastian hasn't taken all your Heinekens out of your fridge in the studio, give him a beer.
He's actually working on Goose Islands at the moment.
Oh, the Goose Islands. Got it. So, yes, as usual, the minions are doing a good job. So what I want to go through today, folks, is a frustration that oftentimes people have, and it might not necessarily just apply to a covered call trader, but in my world, in the collar world, the biggest frustration of the collar is when the stock goes through the short call, the covered call section of the collar, and you're feeling like, oh crap, I got to roll up this covered call. The second you roll it up, it goes right back down. It's just a frustrating thing all around. So what I want to go through today, and not to say that that's the worst thing in the world, because you are making your maximum amount of profit when it does go through your covered call, but what is an alternative of what you could do if that is something that's not conducive to what you're trying to do as a trader? Now, I've talked about on this show before how you can, instead of doing a covered call, you can sell a call spread. And I know Mark's talked about that a lot as well. And that is one choice. But today I want to give you another thought as to what you can do, a way with which to trade if you are looking to have some type of protection on the stock. But instead of giving up some upside, then perhaps you want to take on a little risk to the downside. So let's say that XYZ stock is trading at, we'll say $100 per share, and you want to do a collar on it. You want to sell the 105 covered call and buy the 95 put for 3 months out, let's say. Very basic collar. We'll assume no cost to the collar, meaning that the price of the covered call will evenly match the price of the long put. You sell the covered call for $3, you buy the long put for $3 as well. Costless collar, very simple trade when doing this. And what this does is this gives you the ability to have potential of $5 upside with only $5 of potential downside. It's very easy, very simple. If the stock goes up enough, you'll make up to $5. If the stock goes down enough, you'll lose only up to $5. Or you'll be somewhere in between. Now, this is, of course, assuming you hold all options until expiration, which may or may not be a good idea to do. I couldn't even tell you the last time I've done that. Now, let's move on. You've gone through this trade several times. You've done it, and this stock is just driving you nuts. You think that just after you're in it, you're like, you know what? How could I do something like this, but not have to limit so much upside? I like being long stock, long put, but I have a problem just giving up all this potential upside because this stock's going to go to 120, 130, and I don't want to be the dork who sold the 105 call on it. So what I want to tell you about today is a way with which you could do this as kind of an alternative with just a traditional collar. This would be more of an active collar type of trade. I've done this many times. I've talked about it on the show before, but I kind of want to go through the concept of how this can be done. Okay, so step one, you find a stock with which you like, and you decide that you like the idea of being long stock, long put. So what we can do is we can buy the stock and we can buy a put option. Now, instead of going a little bit out of the money with this put option, let's be a little bit more aggressive on this and let's go at the money with this put option. Now, with that being said, of course, you have unlimited upside at this point and you have downside right from it being at the money. Now, what you've done is you've not gotten rid of risk, you've simply shifted risk. Instead of having risk on the stock, you now have risk on the premium with which you paid for the put option. So in other words, let's say that you paid $5 for this at the money put option. Your risk is not the stock at all. The risk is the $5 that you paid for that put option. And that's, of course, time decay. Now, the key to all collars, folks, is trying to figure out how do we finance that time decay. And that's what, if you understand how to do that, or if you can figure out ways with which to do that, then you're going to be a successful collar trader. That's the whole point of the collar itself. If God told me that the stock was going to go up. And just so you know, God does not tell me what stocks are going to go up and go down. But let's say that God told me XYZ stock's going to go up the next day. I'm going to buy XYZ stock. I have no reason to put a collar on it because God told me it's going to go up. Once again, God doesn't tell me what stocks to pick. But
God tells you what stocks are going up and down, Mike? That's awesome.
No.
You know what? I'm going out to St. Charles. I'm trading there forever.
Well, there you go. Well, it's funny. I did send an email to a client once, and I said that with the action in GLD, and she said that she misread it, and she said it came out to something about that with the action that God told me, I decided to make this trade. So she said she got a little bit concerned for a while.
It certainly gives you a little more confidence in your trading. God's on the bid and on the offer.
It does. So what you can do then is, as this trade goes on, let's say you buy the put 3-4 months out, whatever the case may be, the way with which to finance the put would be to, whenever the stock has some type of a dip, you can sell a put spread on it. Now, it would not require, assuming the put spread is below where the at-the-money put is, it would not require any additional capital because of the fact that the short put that you're selling, and we're selling a short vertical put spread, the short put that you're selling would be, the risk department would view that as a diagonal put spread using the initial long put as the long put and the short put that you're selling at a closer term as the short put. So it would not require any additional capital. And the basic gist is that whenever you get a dip, sell a put spread. Now, you'll say, but Mike, what if the stock goes up to 180 right away and you don't get an opportunity to sell any put spreads? And my response to that is, well, who cares? You just made $75 on the trade. So with that is just another way with which you can trade a collar, and you have the ability to use an alternative means of financing besides that of the covered call. Disadvantage, of course, you'll have that risk of the put spread in there. But once again, option trading is not about getting rid of risk. It's about shifting risk. And this is a way with which to shift risk from eliminating any upside above the covered call to a small amount within the put spread.
All right, thank you for that, Uncle Mike. And we still got a few minutes, so I want to make sure we at least get a couple of people featured on the old show today. So without further ado, we'll dive into a real quick mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody. Welcome to the Mail Block. Our conversation continues here in between the segments on the show. A lot of people hitting us up live. I'll try to get to a couple of them here on the show, including Trader Anki. He wants to know, I'm new to the show, so first off, welcome. Then he or she goes on to say, what's your take on the P&G, so Procter & Gamble, OC 120 option, specifically OC, so expiring on the 7th, with around 2 million open interest and combines over 5 million open interest for October. We hit on this a bit on last episode. It's just stunning volume. It's obviously a takeover play. They're spinning off, I think the division is called Coty, the fragrance division, something along those lines, and there's a tender offer involved. And it's a way to get really synthetically long.
It's actually a pretty complex.
Yeah, I think you wrote up a big thing for this on your site, didn't you?
I wrote it for, I do some research for Tulip Prebon. Prebon had a bunch of clients wanted a kind of an in-depth look at how the P&G deal worked. And so I wrote it up. Sorry, Ben. The basics of the deal are P&G is selling their beauty assets that are not oil of Olay. So there are other beauty aspects, their salon stuff, all that, to Coty. Coty is a company. But in order for it to be a non-taxable event, they have to jump through all these hoops. So what it really turns into is they are running a tender, which then would convert into shares of Coty, convert P&G into shares of Coty at a 7% discount if it hits kind of the top ratio number. And in order to kind of get involved in this deal and try and capture that 7% without having a bunch of delta risk, one needs to engage in conversion reversal play, borrow the stock, yada, yada, yada. So what you're really seeing in all this option flow is just traders trying to come up with ways to acquire P&G stock to tender to then convert into Cody stock at a 7% discount without taking a bunch of delta risk, which is directional risk, in Procter & Gamble. The other interesting piece to look at is if you want to see how successful these guys that have this on think they're going to be, look at how many of these conversion reversal are actually going up in Cody, where there should be some of that stuff, because we're in the pricing period, I believe, right now. So that's the key. These are like the key days.
I think it was like yesterday and maybe today or something like that.
I think it's either through today or it's through tomorrow is the pricing period. So there's some really important things going on with this P&G deal right now.
We talked a bit about this, obviously, on Monday's show, but it's an ongoing issue, and people are obviously obsessed with it. We have a lot of listener questions about this. Really quick before we wrap up, anything, Uncle Mike or perhaps Ben, maybe you guys are putting up some paper on this. You've seen some interesting flow on the P&G deal. This certainly has been a good time to love your broker out there on the P&G business. So anything, Mike or Ben?
Nothing from me at this point, but I do love my broker, of course.
Who doesn't love their broker? Ben, that's what we call a lot of trades that go up here on the odd block in particular that maybe don't make a lot of sense, but there are a lot of strikes very close together and a lot of size. So we kind of just surmise that someone really likes their broker and they want to generate a few transactional fees.
Yeah, I would just echo what Mark said. I mean, this is a pretty structured, what I would consider M&A or mergers and acquisitions or corporate action trade. So it's basically just people trading the spread between what they think they can make off of owning one, tendering, and receiving the other at a discount. So, it's a pretty math intensive / corporate action trade. So those things tend to trade in really huge size. There tends to be a relatively defined kind of risk band, which I think is attractive to traders. And certainly because these are very nuanced, I think they tend to. It tends to be a relatively narrow swath of the community who is actually trading and putting these on, because it takes a high level of sophistication to really fully walk through the trade and understand all the aspects and make sure that you're pricing it properly.
Yeah, this is a trade that requires skill and scale, is the way I describe it. And let me say, Ben, I love my broker.
I don't know about you, Mike, but I'm deeply disconcerted by all the love here between Mark and Ben. I'm glad they're not both in studio with me. It might be a little bit uncomfortable. I could be a bit of a third wheel here. So
for those of you that don't know, is my little hedge fund clears Convergex. So Ben and I have a side relationship besides the option block.
A deeply loving mutual relationship. Before we get into that, let's keep on rolling into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. That is indeed the portion of the program where we break down what is moving, what is shaking, not just for this week, actually, but for the week to come, and indeed into the old weekend. A lot of interesting stuff to keep an eye on this week. Ben, you're our guest, so I'll give you pride of place here. What are you watching for the rest of this week and into the old weekend?
I think the biggest thing that's going to really move the market is the election. I don't think that the economic numbers that are coming out are really going to play that heavily. I think to the extent that Trump can keep things close and make it look like it's a hotly contested election, I think you're going to see higher levels of implied volatility moving into the election. To the extent that storyline doesn't play out and Hillary starts to pull ahead more, I think you would expect to see a dampening of volatility. So we saw vol sell off very quickly after the last spike in vol, and I would anticipate that unless we see a very close contest, that vol would continue to sell off. And if we do see a very close contest and or there's more murmuring about interest rates, I think you'll see, some actual volatility in the marketplace.
Yeah, we certainly, I think a lot of people going into this week kind of discounted the impact of Trump tightening up the race and, of course, the debates and everything else would have on volatility. We were, in fact, just talking about this on our Volatility Views program last week about how it didn't seem like it was really accreting to much. And then, lo and behold, this week, a lot of new polls come out showing Trump is closing the gap, or indeed, perhaps even within spitting distance of Hillary. And then, of course, the debates. And all of a sudden, we have a whole new ball game 1 week later, which is kind of interesting. Speaking of which, we did ask our listeners really quickly our question of the week this week. How will the election impact the VIX? We got a little political. Said, are we heading for a Trump ocalypse or a Clint astrophe? So far with a couple of... We get creative here every now and then on the old network. So far, with about a couple days left, it's still at the end of the week, but about 40% saying it's going to be a spike over 20, and that Trump is going to be the cause. Only 8% saying Clinton's going to drive the VIX over 20. About 20% saying no impact, so still somewhere in this 12 to 14 range, a little bit higher than that today, obviously, where it's meandering. And about a third saying, only a modest increase, about a 15 to 20, which is substantial, but still, compared to shooting up to the 40 handle, pretty modest indeed. I don't know. What are you feeling, Mr. Greasy Meatball? Are you feeling Trump-ocalypse? Or are you feeling Clintastrophe?
All right, so how hilarious would this be? Well, all right, so now let's put together a scenario here where Deutsche Bank actually does go under or has a real problem, and Europe doesn't do its job to really step in. The markets sell off, which then, of course, obviously slows down the economy. And thus, the Europeans, who hate Donald Trump more than anything on the planet, then elect Donald Trump president.
Law of unintended consequences,
yeah,
perhaps.
Think about that scenario. Maybe that would get Angela Merkel off her butt if we said if you don't do something with Deutsche Bank, it's going to elect Trump.
That might motivate her to do some bailouts.
Or maybe that gets the Justice Department to back off. Well, if you don't back off, you're going to elect Trump.
Aside from dire doomsday election scenarios.
Elections never matter. It was going to be the end of the world when George Bush got elected. It wasn't. It was going to be the end of the world when Obama got elected. It wasn't. It was going to be the end of the world when everybody gets elected. Presidential elections don't end up really mattering that much for the market.
2000 was pretty rocking and rolling, though. You got to take our hat off to that one at least. That at least gave us something to do for the short term.
It did. Although, you got to think that 2000 was already kind of a mess because of the dot-com bust when everybody's computer reset its date to 1987. There was some weird thing where when those that didn't get the Y2K patch, their computer reset its date to like 1984 or 1983. It was really weird. I'm with the no impact or modest increase crowd. That's about it.
Feeling the modest love. Speaking of all things modest, I
always feel modest love.
Turn now to Uncle Mike Dusa. Uncle Mike, what are you watching for the rest of this week into the weekend, sir?
Couple things. Tomorrow's the last day of the quarter, so be aware for window dressing, folks. If you're looking at this, with where big firms or big hedge funds and or mutual funds want to get the stocks that the pretty people like into their portfolios for their quarterly reviews. And then I agree with Mark in terms of the election. Historically, it has not had much of an impact. I'm in total agreement there. However, over the course of the next couple of months, with some of the things that either candidate will say, I like I said with Andrew on last week, I have faith in our presidential candidates. They can screw up the market with certain things that they say. Hillary's done it with pharmaceuticals in the past, and if Trump gets a lead and he says something, I think he can do it too. So in between now and the election, I think we could have some volatility, but the election in and of itself, I don't see it's going to be much of a. I don't think it's going to matter too much either way with elected.
I think markets and the world in general have basically decided that this election is a bouncer that's asked you which hand you'd rather have broken, or a loan shark collector that said, would you rather me break your writing hand or your non-writing hand?
With that colorful analogy, we shall bring to a close this epic sojourn through the world of options. So we started off talking all things VIX and, of course, all things CBOE. We got into a lot of unusual activity in the realm of Pfizer and Baker Hughes and even everyone's favorite, VNDA Pharma. Got into the P&G stuff yet again. That's still just top of mind for a lot of you. It is a bit of a funky trade. I do realize that, so it's kind of fun to sink our teeth into that one. And we ended, of course, on Trump-ocalypse versus Clint-astrophe. But before we go, one last time, let's check back in with my cohorts here. My partners in crime, see what they have cooking. Ben, in addition to your ongoing relationship here with Mr. Greasy Meatball, what is cooking in the realm of Convergex? And if our listeners like what you're talking about, where should they go? What should they do to learn more?
They can go to our website or they can contact us via phone. We continue to develop new technology, new algos, new ways to access the marketplace and to try and access screen liquidity. So would love to hear from anybody who wants to learn more.
All right. And Uncle Mike, what is cooking in the land of all things going long?
Well, if you would like to buy my book, Go Long, you can do it for your Amazon Kindle. Just type in Go Long, and you can buy it for less than the cost of a Starbucks. Also, if you are looking for a financial advisor who can help prepare you for either Trump or Clinton, which, once again, I really don't think it's going to be that much of a difference in terms of markets, but if you're looking for a financial advisor that can help prepare you as well as is happy to work with options, not only are they allowed, they are encouraged in most situations, give me a call. I'm at 312-212-3531 or shoot me an email at mtusaw@rcmfs.com.
And last but not least, Mr. Greasy Meatball. In addition to emptying our mini fridge here in the studio, what's cooking in the land of all things option pick?
Well, I'm doing a webinar tonight. We'll have that replay posted on the website. And I've got about 3 more chapters left to write in my second book, Trading Options for Edge. Be on the lookout, folks.
Be on the lookout. 3 more chapters left. So that's about 2 years left.
No, I got to be done by October 15th, so I'm in a real push.
You better get moving.
I am the very first book being published by De Gruyter Business.
There you go. You got the clock's ticking, sir. What are you doing here? You got to go right. All right, and with that, we bring to a close this epic journey through the option block. And on behalf of Ben and Mark and Uncle Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing. Of course, for joining us live. We'd love to see you guys too. And we'll see you next week for more of the option block.
Preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.